Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to the community. My name is Bryce, and as always, I am joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. Always excited for these episodes because there's so much going on in markets.
Yeah.
We had a correction in the US. And then earlier this week, the market bounced. But we're watching what's going on in markets around the world. We're investing consistently. And in this episode of Equity Mates, we're going to cover off the news.
Yes.
We're going to answer a community question on stock buybacks. And we're going to take a look at the portfolio of one of America's best investors, a name that isn't spoken about as much as, the Buffetts and the Ackmans, but he is particularly notable within investing circles, and that is the portfolio of David Tepper of Appaloosa Capital.
Alrighty, well, with that said, let's get into it.
News and markets.
So 3 things that we want to cover off. The Australian government handed down its pre-election budget on Tuesday. Bad news continues for Tesla, and Meta have just given us a textbook example in how to poorly manage criticism. So let's get stuck in, Ren. Aussie budget.
Yes, pre-election budget.
Yeah.
They handed it down, and my big takeaway was
Meh.
But I think...
Aren't all budgets meh?
I was expecting something, to get excited about pre-election.
Yeah.
But obviously the fact that after 2 years of being in surplus, we're now back in deficit, obviously dulled their ability to act.
Yeah.
I guess the headline is $150 for Australians in energy bill relief, which for me just... I mean, I don't know if you want me to get on my high horse here, but
You're about to anyway.
Yeah. Like, where's the structural change? Like, if energy policy is the thing that we're going to focus on, I almost feel like we should say to governments, to solve the problems, you can't give handouts anymore. You have to focus on structural change. It's Ezra Klein in the US. He's just written this book, Abundance, and it's all about like supply side liberalism. Like how can we focus on actually like creating more of the goods or the services that we want to give people access to, rather than demand side liberalism, which is like give people money to afford the limited supply of goods. And in many cases, we give people money to afford the goods, but also then artificially constrain supply with red tape and regulations. Housing being one of many examples, childcare being another example. And so for me, this is a classic example of like, we're not going to change the underlying structures. We're just going to give people money to afford it. Demand side liberalism. Let's focus on supply side liberalism. Let's, if we want to bring energy prices down, gas prices in WA for the last decade have been about half the gas prices on the eastern seaboard because of their reservation scheme, which as of September last year now requires 80% of onshore gas to stay onshore for domestic use.
Yeah.
Let's do something like that in Australia, across Australia. I mean, rant over, but it's just like, let's get some structural change in here.
I guess it's good. I did see earlier in the week Jackie Lambie going hard at it as well on the news.
On the reservation
scheme. Yeah, I feel like it's a policy that people can really get around and understand. It's like, how do we have this issue when we're so rich in resources?
Yeah, we are us and Qatar are the equal most producers of natural gas.
Yeah.
And yet Victoria is building an LNG terminal to import natural gas.
It's wild, yeah.
Nuclear has become an issue. Why wouldn't the Labor Party dull it as an issue and just overturn the ban on nuclear energy and then make the issue, should we be paying all this money to for the government to build nuclear power plants and fight the election on that, and then try and entice all these big tech companies that are investing billions in nuclear to try and build some energy infrastructure here. Anyway, bigger ideas, please. What else do we need to know from the budget?
So $150 in energy bill relief. A couple of notable ones relevant for the community. So student debt relief.
Yep.
The government have announced
student debt relief if you re-elect us.
Yes, that is the catch. That is the catch. Government have announced a 20% cut to all student loan debts and relaxing the lending rules for student loan debt holders, which are two kind of separate things. But if you go and try and get a mortgage, for example, your student debt impacts your the amount that you can borrow. The 20% debt reduction is planned to take place, as you said, Ren, on 1st of June 2025 if Labor is re-elected. Anyway, and the second is superannuation for on parental leave, which I think is a great one. $1.1 billion over 4 years to pay super on Commonwealth government-funded paid parental leave for births and adoptions, again, after July 1, 2025.
Yeah, I mean, the gender superannuation gap is pretty stark.
Yeah.
And I think a lot of it comes from time out of the workforce. So
yeah.
I think this is a good move. But yeah, I think pre-election budget, obviously we'll be watching Australian politics a lot over the next few months. Hopefully we see some bigger ideas.
Yes.
All right, well, let's move on to some company news. And really the company that's been front of mind is Tesla.
In the news for all sorts of reasons. They were down as much as 53% from their recent high. They are now down 41% after a recent bump of 12% at the start of the week. And that is because they are getting a step closer to full self-driving over in China.
That's why they're up.
Yes, that's why they're up.
Yeah.
That's why they're up. But the woes continue, I think, more broadly for Tesla.
Yeah. I mean, everyone's aware of the Elon Musk story. Pretty confronting images of like Teslas being burnt and Tesla windows being shot at and Molotov cocktails and stuff, like things you wouldn't expect to see in America.
Yeah.
I think, as much as people are frustrated at Elon Musk, destroying Teslas isn't going to change what's happening in the government.
No.
But I think the sales numbers are the ones that people are worried about from an investing point of view.
Yeah. BYD is certainly the leader now in the space, and I think that's what people are now comparing them to. I think over the weekend as well, BYD came out with an ultra-fast charging solution for batteries. I think they could charge up to 400 kilometers in 5 minutes.
Yeah, I think even more, 475k.
Yeah, which is 4 or 5 times faster than Tesla's ultra-fast charger.
Tesla's supercharger can do like 280 kilometers in 15 minutes.
Yeah. So BYD really putting it up against Tesla, and you can put the two stock price charts next to each other and see how investors are reacting.
Yeah. Scott Galloway had a stat though, even with Tesla's fall and BYD's rise. So BYD's up about 60% year to date.
Yeah.
Tesla's from its all-time highs, as you said, is down about 40%. But still, based on a per car sold metric, each Tesla sold is being valued at about $425,000 and each BYD sold is being valued at about $39,000.
Yeah.
So the market is still valuing each Tesla sold at more than 10 times the value of each BYD sold.
Yeah. Very interesting to watch if you're a Tesla shareholder. Would love to know what you're thinking about it. Come and join us in the Facebook discussion group.
All right, and then one more news story to close it out. I think it's just worth talking about Meta quickly because they have absolutely just screwed this up. So Sarah Wynne Williams was their head of global policy, and she released a book called Careless People about her time at Meta. And the book launched softly. Like it launched okay, but there's been other books about Meta. Didn't do that well. And then Meta sued.
Okay.
And Meta actually won in arbitration, claiming that she breached her employment agreement or her termination agreement. I think there was like a non-disparagement clause or there was some non-disclosure clauses.
Big oversight from her, but anyway.
And so Meta won. And so the court said the book was already published.
Okay.
And so the court said she could do no promotion or anything. So she had to cancel her book tour, wasn't able to promote it at all. But the attention that this court case put on this book has seen it rocket up the charts. It's now like a #1 bestseller. I bought it. I'm like 25 away. Yeah, it's kind of interesting. But this is a classic example of the Streisand.
Yeah.
Yeah.
You know that song?
Yeah, but she's a singer.
I know. So anyway, she had a massive mansion on a cliffside, and someone got a photo of it and tried to put it out there. She tried to suppress the photo so that people weren't aware of where she lived and how big her house was. And by doing so, brought more attention to the fact that she lives in this massive cliffside mansion.
Yeah, the stats are, it was like the photo had been downloaded 6 times before she sued to suppress it. And then in the month after she sued, it was downloaded 400,000 times.
Wow.
So the Streisand effect is where you trying to suppress something brings heaps more attention to that thing. And this is a classic example of what Meta have done.
I'm interested. So did she have to, did Sarah Wynne Williams have to pay any damages, or it's just it's just like you can't promote your book?
I'm not sure.
Like, it's,
yeah. It's funny with a lot of these books, you're obviously getting one perspective, and I think that's notable here. I'm at this stage. She's just gone to Myanmar to open up Facebook in Myanmar, and we know what happened. And now she's involved in Sheryl Sandberg's book tour. And yeah, so it is interesting to sort of see how it works on the inside. But comparing like her perspective of those years of Facebook, and then reading, have you read Chaos Monkeys?
No.
So that's by the guy who basically built a lot of Facebook's ad business and tried to build it was intimately involved in like their ad business, and like the story of like the engineering side of Facebook at that time and the policy side of Facebook, and you're just like putting it all together and getting this perspective of how the business
was run.
Was built. Yeah.
Interesting.
Yeah. There's a lot of people trying to just throw shit at the wall, and she called them careless people. He called them chaos monkeys, but it was really just like they had built this incredible tool and no one knew
what to do,
the impact of it or what to do with it. Yeah.
Well, if you want to keep up with all the headlines that are piquing our interest and that we think are important to you, make sure you're subscribed to our daily newsletter. You'll find a link in the show notes. Equally, if you want to listen to those headlines, subscribe to our new podcast, Headlines by Equity Mates. And in less than 5 minutes, we'll have those headlines in your podcast player every day at 6 a.m.
A cheat sheet is a quick reference guide or concise summary of important information.
So around at the top, you teased us with an investor that is very well known in investing circles, perhaps not as well known amongst everyday investors here in Australia, and that is David Tepper. And this segment is called Cheat Sheet, where we go under the hood of some of the world's best investors to get insight into what is in their portfolios.
Yeah, so a quick one-on-one on David Tepper. He created Appaloosa Management in early 1993. I think he started it after he was passed over to become partner at Goldman Sachs a couple of times, went out on his own. He was pretty successful early days, but he really came to prominence in the GFC. He didn't pick the GFC. He wasn't like Michael Burry or some of those guys who shorted the market at the right time, but he was very opportunistic in the fall and really rode the market hard out of the fall. He was the highest paid fund manager in 2009 as a result, and that sort of really rocketed into prominence. He won a whole bunch of awards, hedge fund manager of the year, blah, 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 in the 2010s, and is a multi-billionaire now.
Yeah.
He bought the Carolina Panthers, the NFL team, in 2018. So that might be how some sports fans know him. And he's famously vindictive, like famously so. If people have read the Caesar's Palace book, Appaloosa is very involved in that story as well. But how's this for a story of how vindictive he is? So I said that he was passed over for partner at Goldman Sachs.
Yeah.
He paid $43.5 million for the beachfront mansion of the former Goldman Sachs supervisor who passed him over for promotion.
Okay.
Demolished it. Built a house twice as big on the same property.
That'll show him.
So that is an intro into
that's
David
who we're working
Tepper.
with. That's who we're working with. Well, let's take a look at his portfolio. As always, we'll start by going through. Let's start with the top 10 holdings, and then we'll talk about some of the key takeaways. So, number one holding and his biggest weighting by far at 15% is Alibaba. Then we've got Amazon at about just shy of 9%, PDD Holdings 8%, Microsoft 6%, and then we've got Vistra, JD.com, Alphabet, and Meta. Is that 10?
I don't think so.
That 9. And then Oracle. That should close it out.
Okay. Very China heavy, very tech heavy. In total, we had to look at its whole portfolio, 35 positions.
Concentrated.
I would say pretty standard.
You reckon?
If that's one fund, 35, 45,
35 to 40.
If concentrated, you'd say is like 15 to 25. But I would say some pretty lumpy positions at the top. So as you said, Alibaba 16%, Amazon 9%, PDD 8%. So pretty concentrated at the top, but also pretty China heavy. So having a look, Alibaba was his biggest position, Pinduoduo, PDD third, JD.com sixth. Baidu was in the portfolio as well at 15, but he's also holding 2 China ETFs, the iShares China Large Cap ETF and Crane Shares CSI China Internet.
Yeah, the ETF of the year at the moment.
Yeah. It's done well. So I think very China heavy, which aligns with another expert investor we looked at recently.
Burry, wasn't it?
Michael Burry.
Yeah, he went hard on China. Yeah, big time.
Which has been a good investments thus far this year.
Yeah, absolutely. K-Web is the Chinese, the China Internet Crane Shares ETF, if you're interested. We've had even our own Andrew Brown talk about it on the show earlier in the year, and it has done incredibly well year to date, up just shy of 25%.
Nice.
Yeah.
Another big takeaway for me is most of US big tech is in there, and what can we read into the omissions? So Amazon, Microsoft, Alphabet, Meta, and NVIDIA are all in his portfolio, so 5 of the Magnificent 7. The 2 missing, no Apple and no Tesla.
Valuation, maybe. Apple's just going sideways as well.
Yeah.
It has done for years.
Microsoft's gone sideways for years, though.
It's a nicer sideways.
The more potential in the sideways.
Yeah, more potential. Yeah. Apple's seems to be lagging, and Tesla, well, we know there's issues there, and the valuation we spoke about at the top of the show as well. Crazy valuation. So not surprised to see both of those omitted. In terms of weightings, though, like NVIDIA only has 1.5% weighting, so it's in there, but certainly his conviction is elsewhere.
Yeah. Another interesting trend that we saw reflected in this portfolio is he's still obviously very bullish on semiconductors. So AMD, NVIDIA, TSMC and ASML are all in the portfolio. Interestingly, AMD a bigger weighting than NVIDIA. So for people who are unfamiliar, AMD is also a chip designer, not maker, like NVIDIA. They've also had success with this AI thematic. Their data center revenue has grown. It's just grown at a far slower pace than NVIDIA.
Yeah.
But still, like, in isolation, it's done well.
Yeah.
But it's that classic, like, do you buy the potentially overvalued winner, like a realestate.com, or do you buy the second place at a cheaper valuation, like a Domain?
Winner.
Yeah, that's generally the theme. Yeah. But Taiwan Semiconductor and ASML as well in there.
So here's the question I'm mulling then. We have the privilege of talking to experts and doing this content day in, day out and kind of getting a sense of where the money's going. There's no doubt that the money's going to China, or has been, and that's really starting to play out. Have you done anything different in the China space? Has it tickled your fancy?
Well, Bryce, I'm glad you asked that question because
that's why I'm here.
I've actually been set in China for a while. You may have heard of my core portfolio.
I have.
And one of the 4 ETFs in my core portfolio is VAE, which is the Vanguard Asia ex Japan ETF.
Yep.
And its largest holding is Taiwan Semiconductor Manufacturing. But then its second biggest holding, Tencent, third biggest holding, Alibaba, its 5th biggest holding, Meituan. My point being that my core portfolio has China exposure in it.
Yes. To put some numbers to that even further, I think about 35% of the entire ETF is China.
Nice.
So, well answered, I would
Thank you.
say.
But it does make me think, my stock of the year years ago was Tencent. And if anything, it's bigger and more powerful and its network effect is stronger. Yeah, it's such a good company.
Up 23% year to date.
But it's obviously like the China risk is real, like the sovereign risk of a government crackdown is real. But yeah, it's a dominant social platform within China. It's a dominant gaming company globally.
Huge.
Yeah.
PE of 23, up 70% last 12 months. There you go. Anyway, something to think about. We're going to take a very quick break, and on the other side, we're going to answer a community question around stock buybacks. We'll be right back.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, I've got a question.
Your
Answered.
Welcome back to Equity Mates. We love hearing questions from you guys, and today's question comes from Tom. Here it is.
Hello fellas, Tom here. Pretty new to investing and I've got a couple of single stocks and I've just had a couple of notifications about buybacks. I was just wondering if you could explain what that means for investors and if it's something that should concern us or make us, more likely to buy in the future. Thanks, really enjoy the podcast.
Love it. Thank you so much, Tom. We love hearing from you guys. If you want to leave us a voice message to ask a question, there'll be a link in the show notes or the description below. Well, buybacks, yes. What are they?
They're where a company buys back stock from its shareholders and then destroys that stock.
Yeah.
Now, the obvious question is, why would a company do that? And to explain it, let me use an analogy of a pizza.
Okay.
So we've got a pizza. It's got 10 slices. Each slice is 10% of the overall pizza.
Yep.
This is where the analogy kind of breaks down. But if you cut that pizza instead into 8 slices, so you buy back 2 of the slices and destroy them, then each slice is now 12.5% of the pizza.
Yes.
And really the point is the less slices there are, the less shares there are in a company, the more each share is worth of that company.
Yeah.
And therefore the more of the profits you as that owner of the share are sort of nominally entitled to. That's your share of the profits.
Yeah, and so it's a very common way, particularly overseas, for companies to return value to their shareholders. Here in Australia, a lot of companies do that through the forms of dividends. They'll say, here's dividends. But overseas, as Ren said, you've gone from owning 10% to 12.5% without actually having to invest more capital. So the company is giving you a return on your investment.
Yeah, the reason that buybacks are more popular than dividends in a lot of countries outside of Australia is it's more tax efficient. So if a company has money and they buy back the shares and destroy them, they're returning that money to shareholders without creating a taxable event for shareholders.
Yeah.
In Australia, we are one of 3 countries with a fully franked dividend system, a dividend imputation system, where we get franking credits if the company's already paid tax on a profit, so we're not taxed again on that profit. So companies in Australia are much more willing to pay out those dividends and those franking credits. Investors want dividends and franking credits, but in a lot of other jurisdictions, for tax reasons, they would prefer if the company buys back stock.
Yeah.
Now, companies also do them to balance out stock-based compensation. So a lot of companies, especially faster-growing companies, especially faster-growing tech companies, will pay their shareholders with a lot of stock. But even slower-growing companies will give options to board members and senior management. Buying back stock means just a way of sort of balancing the share count.
So, as we said, big overseas, that is really starting to be the trend here in Australia as well. It is becoming a little bit more popular. Last year, 47 companies in the ASX 200 bought back $14 billion worth of stock. If you compare that to 2016, just 13 companies bought back $2.8 billion worth of stock.
So the question is, based on everything I said earlier around Australia having a different tax regime and Australian investors preferring dividends and franking credits, why in the past decade have we seen such a rise in stock buybacks?
Because we always mimic what the US do.
We just copy the cool kids.
Yes. I mean, that could be one reason.
I definitely think that is. Yeah, it's definitely more part of investing
it's
culture
just a
now.
thing now.
Yeah.
Yeah.
There's also a theory that there's been more shareholder activism and more shareholders voting against company remuneration reports, and companies can only get a certain number of strikes or against their board. And there's a theory that boards are encouraging buybacks as a way to drive the share price because satisfied shareholders are less likely to vote against boards. Yeah.
Interesting.
Yeah. Which you know, you could say. And you know, at the end of the day, boards are there to act in shareholder interest,
Yes, of course.
not in company management interest.
Yeah.
And shareholders' main interest is to see the share price keep rising.
Of course.
Like, in some ways, that is driving alignment.
Yeah.
Which is what you want to say.
That's true. That's true.
But look, let's get back to Tom's question. So he asked, he's got a couple of individual stocks. He's got some buyback announcements of those stocks. What should he do?
Nothing. Just be grateful that you own now a little bit more of a company that you had invested in, and get on with life.
Yeah. And if the notification is giving you the option to participate in a buyback, i.e. to sell your shares, have a look at what the market price is, have a look at what the buyback price is, but most importantly, question, does your thesis still hold?
Exactly.
And if your thesis still holds, I'm exactly with Bryce. Be happy that you own a little bit more of that thesis and you haven't had to pay for it and you haven't had to do anything for it.
Yeah. Well, Tom, thank you again for the question. As I said at the start, if you would like to ask one and get it on the show, please leave us a voicemail. There'll be a link in the show notes and description below. But that does bring us to the end of today's episode. As always, if you get value out of what we do, we would really appreciate it if you could spend 60 seconds just giving us a review and a rating in your podcast app, and perhaps tell someone in your friendship group or family group who you think might benefit from this episode as well. Please pass it on. But Ren, as always, great to chat stocks. We'll pick it up next episode.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.